Most traders think they know where support and resistance is. They draw a few lines, wait for a breakout, take the trade, and then watch price reverse right back inside and stop them out. Sound familiar? Here's the problem. Those lines are based on where price has been, not where the market actually cares about. What if instead of guessing, you could actually see which price levels the market respects, where it accepted value, where it rejected it, and where the next move is most likely to start? That's exactly what this tool does. And in this video, I'm going to show you how to read it, how to set it up properly, and a simple strategy that works across crypto, stocks, and gold. Let's get into it. All right, first, let's get this on your chart. Open TradingView, click on Indicators, and search for Multi-Distribution Volume Profile. You want the one by Zierman. Now, if you've used volume profiles before, you might be thinking, okay, I've seen this. But this one works differently, and that difference matters. See, most volume profiles just spread volume evenly across each candle, high to low, like a flat block. But that's not realistic. That's not how the market actually trades. In reality, most of the volume on any given candle clusters around specific prices, usually near the body, near the close, or statistically toward the center. This indicator lets you model that. It uses different distribution shapes to place volume where it most likely actually occurred. That's why this profile looks smoother and more realistic. And more importantly, it gives you a cleaner read on where the market genuinely built interest versus where it just passed through. All right, let me walk you through how to actually read this thing, because once you understand it, you'll start seeing the market completely differently. Thick versus thin, accepted versus rejected. Look at the shape of the profile. You'll notice some price levels have thick bars, and others are thin, almost empty. The thick areas are where the market spent time, volume built there. Buyers and sellers agreed that was fair value. Price slowed down, consolidated, and accepted those prices. The thin areas? That's where price moved fast, low volume, no real interest. The market rejected those prices. It didn't want to hang around there. This distinction, accepted versus rejected, is the whole game. Because when price comes back to a thick zone, it tends to slow down again. And when it hits a thin zone, it tends to rip right through. Now find the thickest single level in the profile. That's called the point of control, or POC. This is the exact price where the most volume traded in your look-back window. Think of it like a magnet. When price drifts away from the POC, it often gets pulled back eventually, because that's where the market found the most agreement on value. See the colored band around the POC? That's the value area, the range where the majority of trading happened. By default, it covers 68% of the volume, which statistically is about one standard deviation. Here's the key insight. When price is inside the value area, the market is balanced. It's accepted. This is where you see chop, failed breakouts, and frustrating back and forth action. Not a great place to be entering trades. But when price breaks outside this band and actually holds outside, the market is telling you something has changed. It's no longer balanced. That's when real moves happen. Now, before we get into the actual strategy, let me share something that changed how I trade. You can learn this setup perfectly, but if you're not at your screen when it triggers, you miss it. And that used to happen to me constantly. That's why I started automating strategies like this, back-tested setups that run whether I'm at my desk or not. These work across forex, futures, gold, and they even work at prop firms. If you want access to the exact strategies hundreds of traders are already using, check the first link in the description. All right, let's set this indicator up properly. Double-click the indicator to open the settings. You'll see everything organized into 3 sections: profile, profile layout, and style and colors. Let me show you the ones that actually matter. First up, profile build mode. This is where you choose how volume gets distributed inside each candle. There are 30 options here, which can feel overwhelming, but you really only need to know a few. Gaussian center is a great starting point. It weights volume toward the middle of each bar, which gives you a smooth, balanced profile that works well in most conditions. Range body only focuses just on the candle bodies and ignores the wicks, which gives you a cleaner, simpler read if you find the full range too noisy. And midpoint only places all volume at the exact center of each bar. Very precise, very clean. I'll give you my specific recommendations for each market in a minute, but those 3 will cover most situations. Next, bars included. This controls how much history the profile uses to build itself. If you're trading intraday and looking for quick breakouts, keep this lower, around 100 to 200 bars. That keeps the profile focused on recent structure. If you're swing trading or want to see the bigger picture, push it higher, 300 to 500 bars or more. You'll capture larger value areas that price respects over longer time frames. Now scroll down to style and colors. The fade metric setting controls what the color gradient represents. Volume is straightforward. Brighter colors mean more volume traded at that level, but freshness is really useful. It highlights where the most recent activity is. So instead of just seeing historical volume, you're seeing where new interest is forming right now. That's powerful for catching moves early. Last one, center of profile. This controls how wide the value area band is. Default is 68%, which works well for most setups. If you want a tighter zone, drop it to 50%. If you want more cushion, push it to 80%. Hit OK. And now let's talk about how to actually trade this. Here's how I trade long setups with this tool. First, I check where price is relative to the value area. If price is inside the band, I'm not doing anything. The market is balanced, there's no clear edge, and this is where most fake breakouts happen, so I wait. What I'm watching for is price to break above the top of the value area and close above it, not just a wick through. I want to see an actual candle close outside that zone. Once that happens, I watch the profile. If I start seeing volume build above the old value area, that tells me the market is accepting higher prices. Buyers are stepping in and holding. That's my confirmation. Now I wait for a pullback. Price usually comes back to test the top of the value area. What was resistance is now support. When it touches that level and holds, that's my entry. Stop goes just below the value area, because if price gets back inside, the breakout failed and I want out. Take profit is either the next high volume zone above, or I'm targeting 2 to 3 R. These moves tend to be fast once they get going. And here's the key. If price breaks back inside the value area after my entry, I exit. No hoping, no waiting. The setup is invalid at that point. The short setup is the exact same logic, just flipped. Price inside the value area, I wait. No trades inside balanced conditions. I'm watching for price to break below the bottom of the value area and close outside. Once that happens, I check the profile. If volume is building below the old band, sellers are in control and the market is accepting lower prices. Then I wait for the pullback to the bottom of the value area. When price tests it and rejects, I enter short. Stop goes just inside the value area. Target is the next volume cluster below or 2 to 3 R. Same rule applies. If price pushes back inside the value area, I'm out immediately. Now, just before we get into the optimal settings for this tool, if you're a serious trader trying to get funded, you need more than a single tool. You need a full toolkit consisting of elite algos that catch the best moves while avoiding losses in sideways markets, proven strategies across multiple markets, whether forex, gold, or futures, with a risk management built in, and fully automated systems so you can trade without being at the screen all day. So if you'd like to stop burning your time and account testing random indicators and start using elite tools and automation like all these other traders, click the link below. Alright, now let's get into the optimal settings for each market. One of the best things about this indicator is that you can tune it to match how different markets actually behave. Here's what I use. Crypto moves fast and breaks hard. You need settings that react quickly. I use Gaussian center for the build mode, freshness for the fade metric, and I keep bars included low, around 100. This setup lets you see where new volume is forming outside the range almost immediately, so you can catch those explosive moves before most traders even realize what's happening. Stocks tend to move more methodically, especially during regular trading hours. They respect value areas well, so you want settings that capture the bigger structure. I go with midpoint only or range body only for the build mode, volume for the fade metric, and bars included at 500 or higher. This gives you clean, well-defined levels that hold up over multiple sessions, perfect for swing trades or position entries. Gold is interesting. It tends to break value areas cleanly and then respect the edges closely once it's out. When gold moves, it moves. I use linear for the build mode, volume for the fade metric, and bars included around 250. With gold and commodities, you can often keep your stop tight, just inside the value area, and target a high reward to risk ratio, because these breakouts tend to run. Give this a try, play with the settings I showed you, and let me know in the comments how it's working for you. If you got value from this, hit subscribe. I put out strategies and tools like this every week. Thanks for watching. I'll see you in the next one.